Chairman Powell just around the corner, live from New York City this morning. Good morning, good morning. Equity futures slightly negative on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, setting the stage for December and beyond.
We're obviously waiting for Powell.
The most important piece of Fed speak.
What will he say here?
50 basis points is very well telegraphed and priced in.
We've gone from pause.
There's going to be a lot of data.
To pivot.
People are looking for the pivot.
To slow down.
I think there is a slowdown coming through.
To any type of good dovish rhetoric, and it's just not there.
For me, it's not the quantum of rate hikes. It's a higher for longer narrative where I think the tail risk lies.
We are going to stay above 5% through 2023, and that's not what the market's pricing in.
I'm not sure he's going to be totally super impressed by the recent rally.
You have a disconnect, which is dangerous.
I do think we're in for a period of choppiness.
This recovery isn't going to be easy until we see some progress.
Risks to the economy going forward from over-tightening.
Market participants will certainly be focused on that.
Joining us now to discuss is Morgan Stanley's Matt Hornback, James Athey of Aberdeen. Matt, first to you, buddy. What are you expecting from the chairman a little bit later?
Hey, John, thanks for having me on. I think we're going to hear more of the same from Powell's last performance in November. I think it's a pretty clear message. The Fed still has more work to do. They've got a couple more rate hikes, at least, in the pipeline. They're going to stay in restrictive territory for as long as it takes to help inflation come down to 2%. And they don't have to keep rates there forever, of course. They're not going to wait at 5% or above until you get all the way back to 2%, but they're going to be there for some time.
James, are you expecting a repeat of the last Fed meeting?
Yeah, I don't really think there's anything new for JP to say at this stage, to be honest. Of course, he doesn't want risk markets to get carried away. He doesn't want financial conditions to ease dramatically at this stage. I think that the bounce in equities will have been a pretty minor concern for the Fed, but it will have been a concern. He'll want to try and prevent that running too much further, but you know the cat is out of the bag. 50 basis points rather than 75 is becoming the standard, and beyond that, you know, realistically, I care a little bit less about what the Fed thinks today they will be doing in a few months' time. I think the data is increasingly going to be in the driving seat in that regard. If we see soft jobs data in particular, I think that increasingly is likely to stay the Fed's hand a little.
I think this is the question of the moment. Lisa asked it earlier this week on Bloomberg Surveillance. Matt Hornback, what's more important this week, the Fed speak or the data?
John, I think the data for sure. I agree completely with James. I care less about Powell saying the same thing that he said a month ago at this point in time. I care much more about what he's going to say early next year, depending on how the data comes in. If we get what our economists are looking for, 180,000 payroll job gains on Friday, that is going to keep the notion that monetary policy lags are the right way of thinking about things at this point. The data will continue to weaken. So we're at 180,000 on Friday. That's slightly below consensus, but very much below the whisper numbers.
James, are you looking for something in and around 200K as well?
Crikey, I'll leave that game to the economists. I think at the best of times it's a bit of a random number generator. I've been surprised by how robust the labour market has been to this point. I think just scratching beneath the surface of ADP today, beyond leisure and hospitality, the service sector did look weak, and I think that's been the key part of this story is this sort of rotation from goods demand to services demand post lockdowns, and services is clearly a more labour intensive side of the economy. And I think once we see that begin to soften, as I expect we will, I think that will become the main narrative. And there's some tentative signs from ADP today that we may be seeing that.
More data still to come. JOLTS data, job openings in America coming up a little bit later. Mike McKee's going to be breaking all of this down for you. Let's get to Mike right now. Morning, Mike.
Good morning, John. When you're talking about labor market issues and the Federal Reserve, that's the topic of Jay Powell's speech today is the labor market. We'll see what he has to say. The idea that we may be seeing a weakening comes in the ADP report numbers today, only 127,000 jobs. But here's the comparison of ADP to non-farm payrolls for private sector jobs, apples to apples. And the red line there is where ADP changed its methodology. Not sure it makes a whole lot of difference, but the one thing you can see month after month is that ADP has underestimated what comes in from the non-farm payrolls numbers. So it's going to be interesting to see what happens on Friday and if we get the kind of fall back off that we thought. Before that, though, we still have JOLTS, and JOLTS is it's never been important to the markets, but it's become important to the Fed because Jay Powell cites the white line there as a reason why the economy it still needs more restriction because we have a lot of job openings. So that number is something that the Fed is going to be looking for to come down. And we'll see, since we get this number now, and Powell will know it when he gets up on stage, whether he references this, whether it influences what he says or not. But I think the bottom line that both of you were talking about, that Matt and James were talking about as well, is that the Fed is going to be looking at what the markets are doing right now. And you can see financial conditions have started to ease after the Fed raised rates. And now the Fed is talking about going higher, but financial conditions are not. Whether that means it's harder for the Fed to get its job done or not, I think the point is the markets are not respecting what Jay Powell is saying. So he maybe want to go back to the Jackson Hole formula of being direct and telling people we are not going to be cutting rates anytime soon, sort of like John Williams did yesterday with a little more authority because it's the chair speaking.
Mike, great work as always. Mike McKee, thank you. Matt Hornback, I want to pick up on what Mike just said. I think it's really important. Are we paying less attention? Are we less sensitive to some of the Fed speak over the last month?
John, I don't think that's the case when you talk to investors. Investors that we speak with, and what you can see in the New York Fed survey of market participants is that investors broadly are on the same page as the message that Powell and his colleagues on the FOMC have been delivering, that the Fed is not going to be cutting rates in 2023. That is the expectation embedded into the psychology of investors. What you see in market prices incorporate risk premia, John, and this is a classic way of looking at market price. You know, we have about 50 basis points of rate cuts priced into the fourth quarter of 2023. Now, John, look, if I could tell you exactly what would happen in 1 year from now, well, gosh, I would probably be in James's seat, not in my seat. So, you know, I think the issue is we don't know, and markets have risk premiums, and that's what's going on here.
I think you and I would both be on the buy side, putting money to work. So let's put some money to work, James Athey. I want to understand what works in what kind of backdrop. So next year, let's go through the consensus view. And Michael Hartnett would kill me for calling him consensus, but this sounds pretty consensus to me over at Bank of America from Hartnett, the team this morning. They're basically long bonds in the first half of 23, long stocks in the second half, and they say we stay bearish risk assets in the first half, set to turn bullish in the second half as the narrative shifts from the inflation and rate shocks of 22 to recession and credit shocks in the first half of 23, then bullish peak inflation Fed US dollar in the second half of 23. Do you think, James, the long bond works in the downturn that people expect in 23?
Yes, I do. I don't think it is necessarily going to be the best place to be. You know, I totally agree with Matt. I mean, first and foremost, I am sat in this seat, Matthew, and I definitely don't have a clue what's going to happen in a year's time, for sure. But if we just look at market pricing for inflation says the headline rate of inflation is going to have a 3 handle by the middle of next year, and it's going to have a 2 handle by the end of next year. And consensus, broadly speaking, expects there to be some sort of recession. If we're in a world where the economy is in recession and inflation has fallen from 7/8 to 2/3 in a straight line, presuming that the labour market has weakened as you would expect in any sort of traditional recession, I don't think it's unreasonable to be thinking that the Fed might be easing back from tight policy to neutral policy, maybe slightly easy policy. And the long run dot is still somewhere around 2.5. If they assume they meet their inflation target in the long term, that means that could be 200 basis points of cuts. So I agree with Matt that at the moment, pricing incorporates a risk premium. We don't really know. Inflation outlook is highly uncertain. But if we take market pricing at its word, it's not unreasonable to not be too concerned about what the Fed is saying today about what might happen in a year's time. Let's be honest. Once we know that communication is in and of itself a policy tool, it leads to this problem where we know they're saying these things because they need the market to react in a certain way today, not because they necessarily actually believe that's the future that we're headed for.
This is what they want to signal. Now, Matt Hellenbach, with all of that in mind, does the 10-year make sense right now for you at about 377?
I mean, John, like I think that the market had a big reaction in the wake of the last CPI report. Most investors that I speak with see that report as likely to be a one-off downside miss, similar to the one-off downside miss we had back during the summertime. So I think generally 375 on the 10-year would make sense given what's going on with inflation the present moment. But if the next CPI report surprises to the upside, I think what a lot of people are generally thinking, then you should see 10-year yields move a bit higher from here. But from my perspective, inflation has peaked in the United States. We think it will peak this quarter in Europe as well. That should put a cap on long-term interest rates. And I think generally we have seen the peak in long-term interest rates in developed bond markets.
So where is there scope for surprise? This is a question we've all got to ask as we get our hands around what the consensus view is in 2023. Deutsche Bank put this out this morning, guys. I think this is a good thought exercise for us all to go through. They said it's worth remembering that exactly a year ago today, markets were pricing a Fed funds rate of 0.68% by the end of 22 and CPI of 2.6%. Given the huge forecasting miss over the last 12 months, it's remarkable how settled the consensus is around a terminal of 5%. James, can you speak to that? Just where is there scope for surprise in either direction relative to what we're expecting into next year?
Yeah, I think that's a slightly unfair comparison. Of course, if you get the inflation outlook totally wrong, you're going to get the policy outlook totally wrong. And equally, if inflation, as Matthew's just sort of intimated there, right, the uncertainty around inflation is low, it could be that the recent CPI report, not just in the US, elsewhere, was a one-off. It could be that energy prices resume their rise, and we see headline inflation moving higher again. And so all bets are off at that stage. But when it comes to the actual sort of rate policy forecast, you have to take into account other considerations beyond just headline inflation. And the broader economy cannot cope with rates going from 5 to 6 to 7 to 8, even if inflation is sticky at around 8%. And I think that's why markets have sort of settled on 5%-ish for now as being a reasonable best guess for the terminal rate. And again, considering that inflation forecasts start to fall. But where could there be surprises when it comes to inflation? And this is something I've said, not just in this recent episode, but for many, many, many years, we really don't know. We don't understand the concept. We struggle to measure the concept, let's be honest. We see that from statistical changes that are made. And its sort of centrality in terms of the monetary policy framework, in my opinion, is somewhat concerning given how poorly we have macro and micro models to understand it.
Matt Hornback, final word, sir.
I think the biggest scope for surprise goes back to something James said earlier, that central banks' communication could change dramatically if, in fact, inflation comes down like markets are pricing and economists broadly are forecasting. You know, the Fed has already set the scene for a change in their communication next year by starting to focus more on the lags with which monetary policy operate. If you're talking about PCE inflation, either core or headline, somewhere between 2 and 3% by the time we get to the third quarter, all of a sudden the lags with which monetary policy operate threaten to take inflation below your target, which, John, is a problem that the central bankers do not want to get back into. That's a problem they spent 20 years trying to get out of unsuccessfully until the pandemic.
Matt Hornback, James Athey, sticking with us. Coming up on this program, China sending a warning to protesters.
We believe the Chinese people have a right to protest peacefully. They have a right to make their views known. They have a right to be heard.
That conversation up next.
We believe the Chinese people have a right to protest peacefully. They have a right to make their views known. They have a right to be heard. It's obviously a very important event for the people of China, and we're watching it, of course, with great care and great attention.
The United States suggesting China should not interfere with protests. China seeming to push back. The country's top law enforcement body pledging to crack down on what they called hostile forces and their, quote, sabotage. All this amid a record COVID outbreak and further contraction in China's economic activity in November. Team coverage starts right now with Bloomberg's Tom McKenzie in London and Katie Lyons here in New York. Tom, first to you. What's the latest?
Two key things that have come out of Beijing, out of China, just in the last 24 hours or so, John. One is a softening of the language around COVID-0 in the state media and from officials, seemingly to soften up the public for maybe an easing of restrictions. Minimal, they're not moving away from COVID-0, but maybe some easing of restrictions. And we've seen, in fact, in some jurisdictions, for example, around where that Foxconn factory is in central China, of course, producing those iPhone 14s, some movement there to move the dial in terms of cutting back on some of those rigid rules. Transport, for example, has stepped up in some cities as well. On the other hand, as you mentioned, the state security authorities and the state security apparatus stepping up. So you had the former chief spy of China, now involved in ensuring there is security across the nation, saying and blaming hostile forces. This is a line they ruled out back in 2019 during the protests of Hong Kong, so seemingly nodding to foreign forces there. Hostile forces they blamed for this unrest, and we should expect a clampdown, possibly the targeting of some deemed to be ringleaders in these protests. We've seen police, for example, checking people's phones. So on the one side, clamping down on the security front, on the other side, seemingly on the edges, on the margins at least, softening around COVID-0, not walking back from it.
Katie, a softening of the language, a softening of the data as well.
Yeah, a real softening in the economic data because of COVID-0 policy. When you look at the PMI numbers for the month of November, they contracted even further than was expected. The manufacturing print coming in at 48, that was below economist expectations of 49, and of course is in contraction territory, which is denoted by that 50 line. You also had a lower than average estimate than the average estimate non-manufacturing index. That declined to 46.7 from 48.7 in October. And COVID-0 policy and restrictions surrounding it definitely a large factor in that. Remember, Nomura recently estimated that about a quarter of China's total GDP is affected by lockdowns. But maybe there is some good news. Tom outlining some of that in the marginal relaxation of restrictions. But also, after a record outbreak, the case count is starting to ease back a little bit. The line is heading back in a downward direction. And that is lending support to the idea that China is heading at least on a path toward reopening. And that has given a big boost to Chinese assets over the month of November. These moves have been remarkable. The Chinese yuan strengthening against the dollar today, even despite the weaker data, and on the month stronger by 3.5% to the 707 level. This is the best month for the offshore yuan on record. And then when it comes to the equity market, the CSI 300 with a gain of about 10% had its best month since July 2020, and the Hang Seng with a 27% rally had its best month since October of 1998. We have to keep in mind the context, though. Even with a rally like that in November, that index remains down 20% on the year, John.
That move in the Hang Seng is ridiculous. Katie Lyons, thank you, alongside Tom McKenzie. Tom, thank you, buddy, over in London. Back with us for a final thought, Matt Hornback, James Athey. Matt, first to you. As you put together your outlook for 2023, where does China and the reopening theme fit in?
It plays a critical role in how we think about commodity markets in 2023. It also plays a critical role in how we think about the broader U.S. dollar. We have been ahead of the game here in terms of calling for China to reopen. Our chief China economist, Robin Jing, has been all over this, calling for an earlier reopening, a bumpy reopening to be sure, but certainly a reopening. And that plays into our commodity price forecast, certainly in the energy market, where we think energy prices are likely to rebound. And then that also contributes to our outlook for the dollar to have peaked this year and for the dollar to head lower next year as global growth expectations rebound alongside that reopening in China, John.
So, Matt, euro dollar 103, cable 120, dollar China doing its thing. Katie just went through those numbers. Matt, where are you pushing that view through right now in foreign exchange?
Well, certainly euro dollar higher. We're looking for 108 in the next 3 to 6 months. That's a key driver, but also in the emerging market space, John. We think there's plenty of opportunity to be short the dollar against some emerging market currencies, particularly in China.
James Athey, are you on board with that?
In the end, yes. You know, this starting point, and as we move through the end of the cycle, the dollar downtrade, I think, is going to be a huge one. We're a bit more circumspect near term. We believe that the dollar's got one last leg to this rally because, essentially, for the view that you laid out from Michael Hartnett, we still don't think risk assets are in any way, shape or form pricing the coming developed market recession. And we think this last leg down in risk assets is going to give us a bid for the dollar, as we tend to traditionally see. Obviously, once we start thinking about Fed cuts or even pricing Fed cuts properly, we may well find then that the dollar has peaked out. Whether that's a peak higher than the last few months or not is difficult to say, but we don't think the dollar is done just yet. On China, of course, the reopening story is going to be really significant. We see that for markets. Yep. Underneath all of that, China still has some huge growth challenges. They still have very different strategic priorities today to ones we've become accustomed to in the recent past. We don't think China is going to be a source of booming growth anytime soon, even if they do go to a full reopening. You
mentioned Hartnett, B of A. The core call of the team at Bank of America right now is recession in the United States next year, recession in the Eurozone, recession in the UK. Matt, is China reopening sufficient to engineer that dollar weakness that you're anticipating, given we may have recession in the US, in the Eurozone?
Certainly, John, and I think ultimately the dollar going down next year is going to solve a lot of the world's problems, particularly when it comes to inflation outside of the United States. We have to remember the U.S. is a large, relatively closed economy. There are lots of economies that are smaller and more open. And so if the dollar's going down against those currencies, then that will help inflation in those areas come down as well. So the dollar going down on the back of inflation here coming down, on the back of pricing in more Fed rate cuts, as James and I discussed earlier, that's going to help solve a lot of problems next year, John.
On course, potentially, for its worst month since 2010 on the dollar index. Matt, wonderful work as always, sir. Matt Horn back there alongside James Athey. We'll try and catch up with both of you before year-end, no doubt. A couple of headlines just coming through after the Thanksgiving weekend. This from Amazon. Thanksgiving holiday shopping weekend was what they're calling the biggest ever. We'll pick up on that theme around the opening bell. This headline as well from Treasury Secretary Janet Yellen. Much speculation about her future in the administration. She's speaking at a New York Times event here in New York City. She's saying that she plans to stay in her role as the Treasury Secretary. That headline dropping just moments ago. Coming up on this programme, the morning calls and later, Bowersock's Emily Hill expecting a rough start for equity markets next year. That conversation just around the corner. 'Just a little bit more than 4 minutes away from the opening bell. Equity futures unchanged on the S&P, just about positive on the Nasdaq, up 0.2%. That's the price action. Here's some morning calls for you. First of all, from Morgan Stanley, adding Blackstone to its financials finest list, highlighting the stock's compelling valuation and attractive risk reward. Your second call from Stifel, downgrading CrowdStrike to hold after quarterly results, expecting clients to pull back on spending due to lingering macro headwinds. That stock is down by more than 18%. And finally, B of A, Bank of America, downgrading Carvana to neutral, citing concerns about the company's cash burn and liquidity. That stock is down by more than 3%. Coming up, the calls for caution keep mounting. Bowersock's Emily Hill warning that recent gains are just a bear market rally. That conversation up next, your opening bell just around the corner. 24 seconds away from the opening bow this morning. Good morning to you all. Coming up a little bit later, Chairman Powell, 1:30 Eastern time. A little bit later this morning, about 30 minutes from now, job openings in America. Going into all of that, equity futures unchanged on the S&P. On the Nasdaq, basically unchanged as well, up by just 0.1%. On a Russell, up by 0.1% too. There's the opening bow. Switch on the board and get to the bond market. Yields on 10-year Treasury shaping up as follows. On a 10-year high by about 3 basis points. Up on the session, down on the month. On the month, we're down about 30 basis points or so on a 10-year yield. That's driven the inversion, a deeper inversion into the yield curve, 2s versus 10s. In the FX market, what a run we've seen on euro-dollar so far this month. Euro-dollar on the month advancing. The dollar index is down about 4% and some on the month, and potentially heading for its worst month since 2010. Abby's going to dig into all of that in just a moment. Crude right now up 3.4%, reclaiming an 80 handle on WTI, $80 and about 89 cents. Wrapping up the month of November then is Abby
Yeah, John, what an interesting month. It's hard to know where to go. Oil plunging, copper soaring, Bitcoin crashing. But at the end of the day, I would argue the most simple story is the best story to start on, and that is stocks up, dollar down. Now, we this year have been talking so much about yields down, stocks up, but yields are actually mixed on the month. That 10-year yield down sharply, as you were mentioning. The 2-year yield actually up slightly, but the Bloomberg Dollar Index down 4.5%, heading to its worst month potentially since 2009. The S&P 500 up 2.3%. In October, stocks were up, yields were up. So I would say that the continuous factor here for stocks up over the last 2 months, dollar down. As for the big movers, it's not your Apples, your Teslas, or even your Amazons on that great holiday quarter. It is all about China. Nvidia up 16%, chips overall up 12%, having to do with the possible reopening, a positive meeting, of course, between President Biden and Xi. Bilibili, Pinduoduo, look at those moves, up 87% in a month. Pinduoduo up 46%. Great quarters there. Wynn Resorts, the Macau opening, one of the top stocks for the S&P 500. Speaking of the S&P 500, John, it's doing something that it has not done this year, which is 2 up months in a row. There are so many folks talking about this being a bear market rally. This here could potentially be the start of a trend change. We don't know that, but it's worth keeping a note. And it wasn't just stocks that did great in November. It was also bonds. Global stocks in the month of November up 6%, bonds up 5%, the best month since 2008. That means the traditional 60-40 portfolio, John, having its best month since November of 2020. November overall in 2022, not so shabby.
The everything rally, I think maybe we can call it. Abby, great work as always. About 2 minutes into the session, equities on the S&P up by almost 1/10%, on the Nasdaq up by 0.15%. On the S&P this month, biggest laggard, Apple. China disruptions fueling supply concerns. Tim Cook heading to D.C. to meet with lawmakers. A lot going on with this company. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. We're down 0.1% on Apple, but a 4th straight day of declines, its worst run in more than 3 weeks. And as we know, it has been a laggard this month, on track for its 8th monthly decline of more than 12% in the month of November. As you said, Cook has scheduled meetings with Republican representatives Jim Jordan of Ohio, Darrell Issa of California, and Kathy McMorris Rogers of Washington. Important because these are all key names likely to chair top committees that oversee tech when the GOP takes the House on January 3rd. Apple, interesting, trailing the S&P 500 year to date, but an outperformer relative to its mega cap peers despite that recent pressure. It's interesting that the stock still has 37 buys, 8 holds, and just a sell. Really, the focus is still iPhone 14 Pro production in Zhengzhou. The news overnight is that authorities in Zhengzhou have eased long-standing COVID restrictions that have been in place for around a week. However, they have issued a new list of key districts and buildings that will be subject to pretty tight controls. And we're trying to make sense of what this means for iPhone production in the key last 3-month period of the year. Bloomberg Intelligence out overnight with a report or a deck saying that the supply chain issues in China are not fully reflected in Apple's fiscal first quarter 23 sales consensus. They think that that sales consensus should be revised down 3 to 4 percentage points. I think actually there may be a little way to go with this stock, John, because people are still trying to feel out the material impact to the top and bottom line from what we're seeing in China.
And I've enjoyed the show with you and Caroline over the last couple of weeks. Can you just tell me what you've been discussing around the Apple situation with Twitter? And if you can go a step further, how that's playing out down in Washington, D.C. and maybe beyond.
Yeah, I think, you know, the reality is that Musk has a ginormous following, irrespective of his ownership of Twitter. The conversation in recent days on Bloomberg Technology has been, well, actually, what he's been saying about Apple, particularly the App Store, is a conversation that's been going on, right? Epic Games, Spotify have taken this battle with Apple to the courts. So Musk has some sympathy on that standpoint. Many others are shocked that Elon Musk would pick a fight with the world's biggest technology company and Tim Cook in particular. And I think that news overnight about Cook organizing meetings, which may have been in place for a number of weeks now, but they're going to their playbook of talking to DC, the power or the center of power at any given moment, and making sure that Apple gets its point across as well. I think that's fascinating, John.
Ed, great work as always, mate. Looking forward to the coverage a little bit later. Your equity market right now positive 0.2%, 5 minutes into the session, 0.4% on the Nasdaq. Emily Hill of Bowersock Capital joining the calls to fade the recent rally, saying the following: it should not be a surprise that higher interest rates, a strong dollar and rising labour costs take time to show an impact on earnings. The next reporting season will deflate this rally. Emily Hill joins us right now. Emily, where do you think that earnings risk is concentrated in early next year?
Well, I think we may have seen a lot of the earnings risk come through in the tech sector. But, one of the things that's been a surprise to watch is the rally in industrials this year. And, I remember last summer talking to you about Honeywell and our optimism about that company. John Deere, Caterpillar, Honeywell, all the industrials rallying, which is not typically indicative of a recession. But I think we have not seen, in some of those more traditional cyclical sectors, the impact of these higher rates. And that's where I expect to see earnings struggle in that fourth quarter reporting season.
So Honeywell, relatively speaking, outperforming in a massive way this year. Year to date, up by about 3-4 percentage points. Emily, is that the part of the market you'd fade the most then? What's happened with the industrials?
Is that the part of the market that I'd
you would fade, given the rally we've seen?
Fade. Yes, I would be taking some profits in healthcare, industrials, the parts of the market that really haven't seen the impact of inflation, higher interest rates, et cetera. So we may have actually seen, I don't think it's time yet to buy tech and the typical, consumer discretionary stocks, certainly. But most of the air has come out of there, or at least some of the air has come out of that bubble.
So, Emily, where would you hide going into the mess you expect in early 23?
Well, as I've said before, and I should also say, one of the things about our expectation for first quarter and second quarter of 2023 is that there really is a consensus out there that this is a bear market rally, and that we're expecting a mild recession. And I am positive that this is a bear market rally, which gives me pause, because if I'm ever positive of anything, it's I'm likely to be wrong. So where would you hide? We have diversified portfolios. We really like the short end of the curve in bonds. You've actually seen money, Treasury or T-bills at over 4%. We think there are good discounts in small cap stocks where we have a bigger discount against large cap U.S. stocks than we've seen since the early 2000s. Most of these strategies will take a while to play out. We also like international developed market stocks as long as they are dollar hedged, because I do think that this recent decline in the dollar will meet some resistance, and I don't expect it to break through that.
Can we talk about tech as well? On discount, on sale, Amazon down 45% this year. Facebook coming into today down 67%. Microsoft down 28%. Apple down by more than 20%. Emily, what do you say to those people looking at those names with those moves this year, thinking, you know what, I might want to buy that, given what's happened over the last 5 years when we've had kind of drawdowns in those kind of names, they rip off the bottom. Why wouldn't you do that now?
Well, first of all, let's take Facebook out of it. I don't know what Mark Zuckerberg is doing, but that's a totally different animal. So no, I think we need more information about what he's doing with the metaverse before you decide that that's a really good long-term hold. But the other names, yes, I think I think now is a good time to be buying some of these high-quality names that are still going to be around, decades from now. And I would put Microsoft and Apple and Google, I would put all of those names into that category. Just don't expect to make a lot of money on them in the short term. But overall, yes, this is a good time to build positions in some of these oversold tech names. I don't see them as, dramatically undervalued by any means. But for the first time, they're closer in a long time, they're closer to fairly valued. So, yes.
They've been battered, that's for sure, through 2022. Yeah. Emily Hill, wonderful to hear your thoughts on this market. Emily Hill of Bowersock Capital, just another voice who thinks this is a bear market rally, looking for pain in earnings season when it kicks off in Q1 23. Amazon with some news a little bit earlier this morning, looking ahead to get ahead of rate volatility raising over $8 billion in a 5-part bond offer. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, Amazon seemingly seizing a window of opportunity here with the second bond offering of 2022. As you said, $8.25 billion, 5 parts. The longest duration is 10 years. And that, according to people familiar with the matter, is going to yield about 95 basis points over treasuries. And interestingly, this offer size initially discussed was about $7 billion. So it turned out even larger, which indicates a certain degree of big investor demand. What is Amazon going to use this money for? It could be used to repay debt as well as fund acquisitions and share buybacks. But this seems more like borrowing because they can, not because they need to, because Amazon has tens of billions of dollars in cash. And our analysts here at Bloomberg Intelligence say, given that cash amount, funding isn't needed. It just provides incremental funding power. And a number of other companies are looking for firepower as well. The Amazon deal was one of 11 investment-grade offerings yesterday, and Bloomberg's informal survey of underwriters this morning indicates another 5 may come today. So they may be looking to take advantage of the fact that spreads have come in. IG spreads are currently around, 130 basis points, which is more than 30 basis points below this year's peak of 165, and the cost of issuing debt has also fallen since the high it reached in October. It now sits at about 5.36%. So maybe it all comes down to timing. And on that note, I would just point out that when you look at U.S. corporate bonds, the largest clump of them mature in 2025, and about $1.8 trillion worth will mature between now and the end of that year. And with unknowns about what rates and spreads are going to look like and concerns around an economic slowdown, companies may be looking forward at uncertainty and deciding to act now, John.
Kelly Lyons, thank you. About 11 or 12 minutes into the session, the S&P is basically unchanged, on the Nasdaq up by 1/3%. Coming up on this program, lawmakers rushing to avoid a rail shutdown.
I don't like going against the ability of unions to strike, but weighing the equities, we must avoid a strike. We could lose 750,000 jobs. That must be avoided.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, World Bank President David Malpass. That conversation at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
We must avoid a strike. Jobs will be lost, water will not be safe, product will not be going to market. We could lose 750,000 jobs, some of them union jobs. That must be avoided.
This was something that was celebrated by this administration, that it was fixed. And now, right before a holiday season, we have to rush something to the floor.
We're going to try to solve this ASAP.
All hands on deck in Washington as Congress seeks to avoid a rail strike. A House vote underway to implement the tentative deal reached back in September. Amid oppositions from lawmakers, Republican Senator Marco Rubio writing in a statement, just because Congress has the authority to impose a heavy-handed solution does not mean we should. It is wrong for the Biden administration to ask Congress to impose a deal the workers themselves have rejected. I will not vote for any deal that does not have the support of the rail workers. AMH joins us now down in Washington. How tense is this one getting, Anne-Marie, where you are?
Well, it is a very tense moment, and it's a tricky one for the Biden administration because not only did the president intervene personally to try to get a deal done in September, but we do not have the votes out of 4 of those 12 of those labor unions, and it comes down to sick leave. And what you're going to see, Jonathan, is that the House is going to take this up to implement this tentative agreement to make sure that they avoid a rail strike. But Speaker Pelosi says that she is going to vote for sick leave. This would be a technical correction to that legislation. Then it goes to the Senate. And while you do hear from the likes of Senator Rubio, you also hear from Senator Sanders, individuals who are saying they are not going to vote for it if the workers' demands are not in it. And it's the fact that the workers are the ones that did not sign up for it. You do have Senator Thune, number 2 senator on the GOP, saying to Bloomberg News just yesterday that a significant number of the Republicans will vote for this because the Republicans and the Democrats on both sides, even if the fringes don't agree, understand the devastation this can cost the economy. And we're hearing from that already this morning from Treasury Secretary Yellen, talking about the disruption, the significant disruptions this would cause the economy as she's speaking at the Deal Book Summit.
It's all go after the midterms. We thought maybe there'd be a rejig of the cabinet, maybe a rejig of the Treasury Secretary and that seat. AMH, it sounds like Treasury Secretary Janet Yellen's going to be sticking around.
Yeah, it does sound like she's going to be sticking around, Jonathan. I mean, there's lots of always reports about potentially how there's going to be a shakeup in the administration, especially when it comes after midterms. But one thing that it's important to remember is that there wasn't this red wave in the midterm elections, which also maybe would have given the White House a little bit more oomph to say we're going to be shifting individuals around. At this point, they can maybe keep a lot of people in these same positions. A lot of people may want to stay in these same positions because there wasn't this quote unquote red wave. And actually, the Democrats were able to hold the Senate, pick up a seat, and really only lost the House by a very slim number.
Is it your sense, Anne-Marie, that the railroad issues they're dealing with right now could just be the start of something much bigger? I'm thinking of the negotiations that have dominated much of the year, back end of the year, with the West Coast dock workers over in LA. Are we going to see much more of this?
Well, it does seem like in this moment in time in the economy, whether or not it's the labor unions or businesses as well, you do see employees feeling like they have more, they can make more demands to their employers. We are definitely seeing that with labor unions. Now, we should note that the majority of unions did vote for this tentative agreement. It's 4 of them that did not. And one of the biggest ones has to do with conductors. And this really comes down to sick leave. Potentially, you can see their demands being implemented in this tentative agreement. But you have a president who's also been leaning into labor demands. He has campaigned on the fact before he became president that he wants to be the most pro-labor union president we've had in modern times. This is why it is so tricky for him at the moment, because at this moment in time, the White House is leaning into protecting the economy instead of protecting what the labor unions say should be their right.
AMH, thank you. Anne-Marie down in D.C. We mentioned those comments from Secretary Yellen. Some other comments from Secretary Yellen in the last couple of moments as well. I misspoke on Musk and the Twitter deal in comments to CBS. I want to get back to Ed Ludlow on this on the West Coast. Ed, can you translate that headline for us?
Yeah, so Yellen speaking at an NYT event, and what she's saying is that the comments she made previously to CBS back earlier this month, end of October, about CFIUS or a potential CFIUS review, she was wrong. I misspoke on Musk and Twitter. She effectively said that at that time, the Treasury and other related parties as part of the CFIUS committee would not be looking at Musk and his purchase of Twitter based on their foreign ownership in the private entity. We've been looking into this, right? Because if you look at the cap table, which we don't have a full picture on, of the private Twitter, there are outside foreign investors that either rolled over their public shares or bought into the new private equity as part of Musk's take private deal, which closed October 28th.
Going to be more on that a little bit later, no doubt. Ed, thank you for breaking that down. Need to break down some economic data for you as well. At the top of the hour, we'll have JOLTS job openings. Mike McKee back with us for some data from a couple of minutes ago. Hey, Mike.
Hey, John. Well, it's raining in New York, it's raining in Washington, and I am your little dark cloud today in terms of economic data. The Chicago PMI is just out 37.2, a major drop in that index from 45.2 the month before. It is an index that is very heavily influenced by the auto industry because of the Chicago area's location. So we'll have to see what this ends up meaning, if anything, in terms of the labor market. Now, we did get the report today from ADP that showed 100,000 jobs lost in manufacturing. I'm not sure if I believe that. I know Neil Dutta was on with you and really thought that was a ridiculous idea. But take a look at, if we have this chart I sent along that shows all of the PMIs from all the regional feds have now come out for the month of November. Chicago PMI is not produced by the Fed there, but so it's on a little bit different scale. But all of them, except for the New York one, which is up maybe just a touch over the zero line, all of them showing contraction. So manufacturing contraction across the board, across the country, in all of these regional PMIs. It's not going to be good news for the economy, but it may be showing that the Fed and its tightening is starting to work.
Brutal. Mike, looking forward to your breakdown of the data coming up in about 7 minutes as well. Mike McKee there. For the broader equity market, we're down about 1/10% on the S&P with a sector price action. Here's Abby.
John, well, it's interesting that bad news is not translating as good news right now, perhaps because it is so regional at this point. The S&P 500, as you mentioned, down slightly. Not a lot of drama sector-wise. Healthcare, the best sector, up 0.3%. Energy, tech right there, too. Financials, real estate are both down. But on the month, what a month it's been. And the overall message, basically, industrials and materials, those are the best sectors. And if we take a look at it a little bit more, chips also having a great sector, staples, durables, and then to the downside, it's all about tech, that Apple that you were talking about. And then speaking of autos, well, they're down on the month in a big way.
Abby, thank you. Up next on this program, your trading diary. What a couple of hours we've got coming up for you. This is Bloomberg. 25 minutes into the session, pretty muted price action here on the S&P, basically unchanged, slightly positive on the Nasdaq by 1/3%. As the price action, here's the trading diary. First up, top of the hour, Jolt's job openings coming up in about 4 minutes' time. President Biden speaking at 11:30 Eastern, followed by Fed Chair Jay Powell at 1:30 p.m. I'm hoping he wraps that up quickly. Argentina playing at 2 p.m. Eastern time. Jobless claims tomorrow morning. Then it's on to payrolls Friday. The estimate in our survey, 200K. From New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.